There's a company that made $13 billion last year, and it's still losing money. Yet the world values it at $852 billion. If you're thinking that math is broken, you're not wrong. But the real question isn't why that math is broken. The real question is how that math is working. And the answer will tell you what the entire AI industry is actually built on today. Most people assume a company's value comes from its profit. The more money a company earns and saves, the more the market prices it. That logic holds up fine for ordinary businesses. But when it comes to AI companies, this logic flips completely. Here, the highest valuations go to the companies burning the most cash. And that's exactly where this whole story begins. To understand this, you first need to know how an AI company's value is actually measured. When someone says a company is worth $100 billion, it doesn't mean it has $100 billion sitting in a bank account. It means that the last time an investor put money into a small slice of the company, the price of that slice was used to calculate the value of the whole company. In other words, a valuation isn't a fact, it's an estimate, and that estimate rests entirely on what investors are willing to believe about the future. This is where things get interesting. Take OpenAI. In 2023, its valuation was pegged at around $29 billion. By early 2025, it had climbed to around $300 billion. And in March 2026, when the company closed a $122 billion funding round, its post-money valuation hit $852 billion. In 3 years, the valuation multiplied 30 times over. In any normal industry, that would sound impossible. In AI, it's the pattern, not the exception. So the question becomes, how does a number this big get built this fast? To answer that, we need to look at something most people overlook: what the company is actually selling and what investors are actually buying. On the surface, it looks like OpenAI sells a chatbot and people buy its subscription, but the investors putting in billions aren't buying a chatbot. They're buying a future in which this same company controls the most important technology of the next decade. The product stays the same, but what's actually being sold is something entirely different. Here's the first big twist. If you think these funding rounds are just about cash, you're missing the full picture. When NVIDIA puts $30 billion into an AI company, a large chunk of that deal often comes with a condition. That money flows back into buying NVIDIA's own chips through that same company. So the money leaves one hand and lands right back in the other, and what's left in the middle is mostly a very large number on paper. The industry calls this a compute commitment, or a circular deal. The same money circulating again and again, pushing every company's valuation higher. Amazon, Microsoft, SoftBank, this same pattern shows up across their deals too. Now hold on to that number from the start. $13 billion in revenue. That number isn't bad. In fact, it's extraordinary for a 3-year-old product. But put it next to that $852 billion valuation. That means investors are pricing the company at roughly 65 times its annual earnings. For comparison, most stable, profitable tech companies trade at around 15 to 30 times annual earnings. In other words, the market isn't just betting on today's revenue, it's betting that this company will be massively bigger within the next 10 years. And this is where the counterintuitive truth surfaces, the one that catches most people off guard. The more money a company burns, the more the market trusts it. That sounds backwards, but the logic is straightforward. Building AI models requires staggering amounts of computing power. Data centers, chips, electricity, cooling systems. Whichever company can spend the most gets to build the biggest model, and the biggest model is what guarantees staying ahead in the market. So in investors' eyes, heavy spending isn't a weakness. It's the ladder to staying ahead. As long as revenue keeps growing at a fast pace alongside it, the losses get treated as investment, not failure. But this is exactly where the chain reaction begins, the one that could eventually shake the entire industry. Step 1, more users show up. Step 2, serving more users requires more computing power. Step 3, buying that much computing power requires huge amounts of money, far more than the company's current revenue can cover. Step 4, to raise that money, the company has to sell new investors an even bigger story about the future. Step 5, the bigger that story gets, the higher the valuation of the next funding round. And step 6, the most dangerous one. Now the company has to grow even faster to justify that inflated valuation. Each step becomes the next step's obligation. Stopping is no longer an option. To make this chain reaction clearer, walk through OpenAI's timeline in order. In 2015, it started as a nonprofit research lab with a mission to build safe AI for humanity's benefit. Profit wasn't even part of the question. By late 2022, ChatGPT launched, and within months, tens of millions of people were using it. That was the turning point. Suddenly, the company had a real, massively used product backed by enormous computing costs. After that, funding rounds kept getting bigger, faster. Microsoft's major investment in 2023, a round of over $6 billion in late 2024, a $40 billion round in 2025, and then a $110 billion round in early 2026, which later grew to $122 billion. With every round, the valuation number jumped, and with every jump, the need to raise the next amount jumped too. Now look at the other half of this story, the part that often gets buried. Despite raising all that money, in early 2026, the company started shutting down some of its products, including its short-form video app, and cost-cutting plans began surfacing. This is the moment that flips the whole picture. If the company truly had that much money, why would cuts even be necessary? The answer is this: the amount shown in a funding round isn't fully cash. A large part of it comes as computing credits, conditional installments, and funds to be received in the future. One finance professor raised this point directly, saying that once you strip away those conditions and conditional tranches, the actual cash left is much smaller than the headline number suggests, and that $840 billion valuation assumes a kind of revenue growth that no tech company has ever sustained at this scale. This is the part that gets overlooked the most. The real cost isn't hidden in revenue, it's hidden in dependency. For OpenAI, Microsoft isn't just an investor, it's also its exclusive cloud partner. That means the company's entire computing capacity rests on one major partner. If that relationship ever sours, or if Microsoft changes its terms, it won't just break one contract, it'll shake the entire infrastructure. That's the weakness hiding behind the strength that's visible from the outside. A building can look fully occupied, but if most of its rent comes from a single tenant, that building isn't as secure as it appears. Now compare that to another major AI company, Anthropic. In February 2026, it raised $30 billion, reaching a valuation of $380 billion. And later, with a $25 billion deal in January, it stood at $350 billion. What's interesting is that its annual revenue was around $9 billion at the end of 2025. And by March 2026, it had grown to around $19 billion. So in absolute numbers, it trails OpenAI, but in terms of speed, it's growing faster, and this is exactly where investors bet on rate of growth over total size. A company can look big, but if its pace is slowing down, a smaller, faster-growing company becomes the more dangerous competitor over time. Now think about what happens if one link in this entire chain breaks. Suppose, for whatever reason, revenue growth suddenly slows down, maybe due to rising competition, maybe because of a new, cheaper model that performs almost as well. Investor confidence would shake immediately. The next funding round wouldn't come at as high a valuation as the last one, but the company's spending, data centers, electricity, staff, won't shrink overnight. This is the moment where the logic of burning cash is a sign of strength suddenly flips, and that same spending starts to look like a weakness instead. That's why the cost-cutting that began in early 2026 shouldn't be dismissed lightly. It's an early sign that the company itself is aware of this risk. The IPO angle matters here too. Reports suggest the company is preparing to go public by the end of 2026. That move itself says something. Raising this much money continuously from private investors isn't easy anymore. One report noted plainly that raising $50 to $80 billion in private capital is becoming harder because valuations have already climbed so high. When private investors start to tire, the last remaining door is public money, the stock market. And the stock market isn't nearly as patient as private investors. There, you have to show results every 3 months. This is where the optimistic and realistic pictures split apart. In the best-case scenario, these companies genuinely become the foundational technology of the next decade, the way electricity or the internet once did. And today's heavy spending proves, in hindsight, to have been the right bet. In the realistic successful scenario, the company slowly moves toward profitability. But along the way, several products get shut down, some layoffs happen, and the valuation settles a bit lower. And in the worst-case scenario, something that's happened in several tech bubbles throughout history, investor confidence suddenly breaks, funding dries up, and the heavily leveraged structure starts to collapse under its own weight. All three possibilities genuinely exist today, and that's exactly why every big funding headline sparks so much debate. So coming back to the original question, how does an AI company become worth billions? At first, the answer seemed simple. A good product, more users, more profit. But the real answer turned out to be far more tangled. These companies aren't growing on profit. They're growing on a shared belief that this will be the defining power of the next decade, and whoever bets the biggest on it today will hold a piece of that power tomorrow. Chipmakers, cloud providers, and AI labs, they're all circulating money among each other, trying to make a shared future real. It isn't fully an illusion, and it isn't fully solid reality either. It's one massive, extremely expensive bet, and the outcome of that bet hasn't been written yet.